The global economy in 2026 is operating under heavy weather. We are seeing stubborn inflation that refuses to cool off, while conflicts in the Middle East generate storm clouds that disrupt supply chains and drag down growth forecasts worldwide. When this kind of turbulence hits, financial news stations start repeating the same two names on a loop. You will constantly hear that the IMF just approved an emergency loan, or the World Bank just launched a massive recovery project. Because they are headquartered just blocks apart in Washington, D.C., and often mentioned in the same breath, most people assume they are the exact same thing, but they are entirely separate entities with completely different jobs. Treating them as interchangeable means missing how the global economy actually works. To understand the financial levers stabilizing the world you live in, we have to pull them apart.
The reason we have two institutions instead of one goes back to a very specific terror in 1944. World War II was ending, and Allied leaders were looking backward to figure out how to rebuild. They looked at the 1930s. They saw the Great Depression, countries slashing their currency values to outcompete each other, trade collapsing, and spiraling economies. They realized that economic freefall is highly contagious across borders. To make sure that level of collapse never happened again, representatives from 44 nations met in Bretton Woods, New Hampshire, and designed a two-part global financial safety net. The delegates understood that a single pile of money wasn't enough. Avoiding global ruin required two distinct tools, one to stop acute bleeding during a crisis, and another to build long-term economic immunity. That brings us to Pillar 1. The International Monetary Fund is the world's financial emergency responder. Its sole mandate is to keep the global monetary system stable. This chart illustrates their preventative tool, the Article 4 consultation. The IMF performs annual checkups on member nations to catch warning signs early. But if a country's currency collapses and it can't pay for imports, they deploy emergency cash. This cash comes with a heavy catch. Countries receiving loans must agree to strict conditions, usually requiring them to implement painful economic reforms, like cutting domestic spending or stabilizing their currency policy. In 2026, Managing Director Kristalina Georgieva's strategy has increasingly centered on preparing member nations for these exact types of frequent, compounding economic shocks. The IMF's April 2026 World Economic Outlook report was literally subtitled, "In the Shadow of War." They downgraded global growth projections to 3.1%, openly predicting that crisis after crisis is the new normal. Notice what's missing here. The IMF doesn't build schools. It doesn't pave roads. Its purpose is to artificially stabilize the macro system so a single failing nation doesn't drag down the rest of the globe. Pillar 2 is the exact opposite. If the IMF is the emergency paramedic, the World Bank is the long-term architect. The World Bank funds physical, years-long projects. We're talking about financing power grids, road networks, and healthcare systems from the ground up to eradicate poverty. This diagram breaks down how the bank structures that funding internally. Capital flows through two distinct streams: the IBRD pipeline lending to middle-income countries, while the IDA pipeline gives heavily subsidized loans to the absolute poorest nations. Under President Ajay Banga in 2026, the World Bank has aggressively pivoted towards faster, highly concrete results rather than theoretical development goals. This visualization tracks a 2026 initiative called Water Forward, deploying billions to improve water security for 1 billion people by 2030. Simultaneously, their Mission 300 project in Africa successfully connected 50 million people to reliable electricity. The division of labor is clear. The IMF keeps the global ledger from crashing, while the World Bank builds the physical foundations that make an economy worth saving in the first place. Which brings up the obvious question: where do these two institutions actually get the billions of dollars that they deploy? This chart visualizes their funding structure. Member countries pay in through a quota system, contributing funds based on the size of their domestic economies. This creates a transactional system. The money you contribute translates directly into voting power. Because of this pay-to-play structure, American and European policy priorities carry a disproportionate amount of weight in dictating the rules for everyone else. It is the ultimate irony of global finance today. The wealthy nations wielding the absolute most control over these institutions are the ones who will almost never need to call them for an emergency bailout. This power dynamic generates severe criticism. Many point to the Washington Consensus, accusing these institutions of forcing a one-size-fits-all, painful austerity approach on struggling populations who have zero say in the matter. On the other side, defenders argue that strict lending conditions are the only viable mechanism to prevent corrupt or mismanaged governments from instantly burning through global bailout cash with no accountability. For years, there has been talk of reform, of shifting voting power to give emerging economies a bigger seat at the table. But as of 2026, that old hierarchy remains almost entirely intact. The two-pillar system is deeply flawed, politically fraught, and heavily dominated by the West. Yet, when storm clouds actually roll in, it remains the only safety net standing between the modern world and total economic collapse.